What does the Fed's approval of home bank shares actually mean for investors, and how could it shape returns in a high-rate world? Today, we break down the signal behind this green light and what to watch as the plan moves forward. The Federal Reserve has cleared an application from home bank shares, removing a key supervisory hurdle. This matters because, in a market defined by elevated rates, regulatory timing can influence how banks deploy capital, price deposits, and pursue deals. Approvals like this often precede expansions, combinations, or other corporate moves that can affect earnings power, funding stability, and competitive positioning. Here's the substance behind the headline. The board determined the proposal aligned with banking laws and supervisory standards. That implies comfort with the bank's capital strength, risk controls, liquidity profile, and governance. It also suggests the Fed saw no unacceptable harm to competition or to credit access in affected communities. The decision does not end oversight. It authorizes execution under standard conditions and ongoing supervision. Now to the practical implications. With the green light, management can shift from application to action. If the plan involves expansion or restructuring, expect detailed integration work, calibration of capital and liquidity, and tight coordination with both federal and state supervisors. Execution quality will matter more than the announcement. Cost discipline, systems integration, and retention of key clients and deposits will drive whether any strategic move adds value or erodes it. Understanding the approval process helps set expectations. Fed examiners review capital adequacy, risk management, compliance with consumer protection and anti-money laundering rules, and potential effects on market concentration. In more complex cases, they may seek public comment and extend timelines to weigh systemic implications. Passing that review signals operational readiness, but it does not guarantee earnings upside. Outcomes depend on post-approval decisions in a changing rate environment. That rate backdrop is the swing factor. Elevated policy rates are reshaping deposit pricing, loan demand, and asset liability management. Net interest margins, credit costs, and funding mix are all in play. Strategy and timing matter. A well-priced acquisition or portfolio shift can compound returns when funding is stable and credit holds. The same move can underperform if deposit betas rise faster than expected or if credit normalizes more quickly. For investors, focus on milestones. Watch management's timeline, capital and liquidity updates, and any guidance on margins and credit. Track deposit trends and funding costs, not just headline loan growth. Compare execution progress with peers to gauge competitive impact and valuation. Read the full article at finlitica.com